Welcome to this explainer. Look, we're jumping right into the single most practical question every homeowner faces right before a major renovation. How do you actually pay for the whole shebang? It sounds like a simple question, right? But as we're going to see, making the wrong financing choice can literally turn your absolute dream project into a total nightmare.
Just to put the sheer scale of this into perspective for a second, U.S. homeowners dropped over $470 billion on improvements last year, according to the Census Bureau. That is a staggering amount of capital. So if you're currently sitting at your kitchen table, staring at contractor bids, and just wondering how on earth to make the math work, well, you are definitely not alone in navigating this giant financial puzzle. All right, here is our roadmap. We'll start with a reality check on 2026 renovation costs, expose the hidden budget busters, break down cash, HELOC, and construction loans, dive into the 2026 market update, and wrap up with 3 crucial questions you absolutely need to ask.
Let's kick things off with Section 1, a reality check on 2026 renovation costs. We have to start with what major projects actually cost right now. Because, let's be honest, you absolutely cannot finance a project properly without knowing the true size of the target you're aiming at. Based on national data from Remodeling Magazine's 2026 Cost versus Value report, the capital required today is no joke. A mid-range kitchen remodel, and we're just talking semi-custom cabinets and new appliances here, can easily hit between $78,000 and $94,000. An upscale bathroom remodel pushes $88,000. And if you're looking at a primary suite addition, you're looking at an investment that can easily top $200,000. These aren't just small cosmetic tweaks. These are massive financial undertakings.
Moving right along to Section 2, the hidden budget busters.
Now here's where things get really interesting, and where a lot of homeowners get into serious trouble. You must account for a hidden 20 to 30% on top of the contractor's quote. You see, the contractor's bid only covers direct materials and labor. It completely leaves out financing costs, things like loan origination fees and appraisals, which can run $5,000 to $9,000 before a single hammer is even swung. Then you've got soft costs, like architects, engineers, and permits, running another $5,000 to $15,000. And finally, the absolutely most critical piece of the puzzle, a 10 to 15% contingency fund. This is explicitly recommended by the National Association of Home Builders to cover those inevitable, nasty surprises you find hiding behind your drywall.
The main takeaway here is stark, but absolutely crucial. If you only secure financing for the contractor's exact quote, you're almost certainly going to find yourself completely short on funds mid-project. In fact, failing to budget for those indirect costs is the #1 reason renovations stall out half-finished. So on to Section 3, cash, HELOC, or construction loan.
How do we actually afford that full all-in cost without stalling out? Well, let's treat our 3 primary financing options not just as loans, but as specific tools into tool belt. The simplest, most blunt tool is paying with cash. Take a $92,000 kitchen remodel paid straight from savings, for example. Because funding was never a bottleneck and there was 0 bank inspections slowing things down, the project actually finished 2 weeks early. Cash gives you maximum control, 0 paperwork, and absolutely 0 interest. But, and it's a huge but, it completely drains your liquidity. Once that cash is tied up in your beautiful new kitchen cabinets, you can't use it for a sudden emergency, and you miss out on any investment returns that money could have been generating elsewhere. Next up in our tool belt is the HELOC, or Home Equity Line of Credit. Think of this like a giant credit card secured by your house. Lenders typically let you borrow up to 85% of your home's current value, minus whatever you still owe on your mortgage. This is a highly flexible tool, which makes it perfect for phased projects. Say you're doing a $145,000 backyard and bathroom update. With a HELOC, the homeowner only draws funds exactly as needed over, let's say, 9 months. The primary advantage? You're only paying interest on the exact funds you're actively using. The catch? Most HELOCs have variable interest rates. That means if the market changes, your monthly payments can suddenly swing up. And then we have the construction loan. This is your heavy-duty machinery. It's a highly structured tool designed for large-scale builds, like a massive $380,000 ground-up addition. Here's the magic of a construction loan. The lender actually bases the loan amount on the future appraised value of your home, assuming the renovation is completely finished. That gives you way more borrowing power. But the funds are strictly dispersed in stages, which are called draws. The bank will actually send an inspector out to your house before releasing the next chunk of money. Now sure, it requires complex paperwork and carries higher closing costs, usually around $3,000 to $6,000. But that strict inspection process brilliantly protects you from accidentally paying a contractor for incomplete or shoddy work. So, breaking down the showdown, it's really all about trade-offs. Cash eats up your liquid savings but hands you total freedom. A HELOC offers incredible flexibility for rolling, phased projects, but risks your house on unpredictable variable rates. And construction loans. They fund those huge, ambitious expansions by looking at future value, but they bring complex paperwork, bank inspections, and those higher closing costs straight to the table.
The most crucial point we need to emphasize here is avoiding the single biggest meta-pattern mistake homeowners make. Do not, I repeat, do not choose a loan simply because it has the lowest advertised interest rate. You have to map the loan's terms directly to your project's unique scope and duration. Think about it. If you use a 12-month interest-only construction loan for an addition that takes 18 months to build, you are setting yourself up for a severe payment shock. Structure dictates success.
All right, let's jump to Section 4, the 2026 Market Update.
Let's see how today's specific economic reality impacts these financial tools. The really great news for 2026 is that the wild volatility we saw in the early 2020s has mostly settled down. Borrowing rates for HELOCs and construction loans have stabilized into a pretty predictable 6 to 9% range. Furthermore, the Producer Price Index shows that material costs have thankfully cooled off, rising only about 1.5 to 2.5%. However, skilled labor shortages are still a thing, meaning construction wages are up roughly 5% year over year. And crucially, whatever you do, do not forget the Inflation Reduction Act. Tax credits for things like heat pumps and high-efficiency windows can offset costs by up to 30%. That makes energy-focused upgrades incredibly financially attractive right now.
Which brings us to our final section, 3 crucial questions to ask.
Before you sign a single bank document or write that very first check, you have to look your lender and your contractor right in the eye and ask these 3 things. First, what is the true all-in capital required? You need to force them to include the borrowing costs and that 15% contingency we talked about. Second, what is the specific draw schedule? Look, if a contractor wants 50% upfront before even pulling a permit, run. Always tie payments to past inspections. And third, what is the projected return on investment? Our data shows a mid-range kitchen might recoup about 60% of its cost at resale. You absolutely need to know these numbers so you aren't severely over-improving for your specific neighborhood.
The Renology methodology perfectly summarizes this entire complex landscape. True affordability isn't just about finding the cheapest rate on a spreadsheet, it's entirely about utilizing the exact right financial tool for your specific renovation job. You want to use a scalpel for a phased bathroom update, and you bring in the sledgehammer for a brand new second story. Which leaves us with this critical question for you to consider regarding your own home. As you plan that absolute dream renovation, and you're looking over those beautiful design renderings, take a hard, honest look at the numbers. Is your financing timeline perfectly aligned with your actual construction timeline, or are you accidentally setting yourself up for a mid-project budget crisis? Matching your timeline to your money is the ultimate secret to surviving a remodel. But of course, that begs one final critical question. Once the dust finally settles and your bank accounts are drained, will your local housing market actually reward you for the investment you just made? Well, that is an entirely different explainer. Thanks for watching.